Hello, everybody. Today's going to be lesson number 5. If I recall correctly, I'm not really sure. Maybe lesson number 4, lesson number 5, I don't know. So today we're going to go one step further. We're going to be talking about the London algorithmic delivery of price. Okay, London algorithmic delivery of price. Now, if you recall, remember what an algorithm is, right? Or remember what an algorithm tries to do. That is what? To get a job done. Okay, so now we learned what Asia was supposed to do. Asia was supposed to basically create or generate liquidity, and there are instances in which Asia also raids other important liquidity pools that lead to large range Asias, okay, or rather, let's say large Asian ranges. So we understand that a large Asian range can lead to a quiet London, or it can lead to an explosive London, and then maybe a New York continuation, or a choppy, quiet New York session. Okay, so it all depends on how Asia delivers. Okay, it all depends on how Asia delivers. London algorithmic delivery depends on how Asia delivers. So we know that. So you're going to apply that to your trading if you want. Okay. All right. So the London opening price. So the London opening price is very important. Look at the London session commences its trading at 1 a.m. EST, but we don't begin the process of looking for trades until 2 a.m. EST. Okay. Now this has something to do with the CLS, which I can't get into in public, as you guys know. Okay. I do that in the private group, but not in public. So the specific time-based trading begins from 2:30 a.m. EST, right? So it follows the liquidity cycle timings. And using the 1 a.m. EST opening price, we can deduce the following. The potential low or high today, if Asia has not done so. So for example, if Asia does not have a large range day, which leads to, the high of the day or low of the day form, we can anticipate this happening inside of London. Number 2, the directional bias for the London 4-hourly candle also starts at 1 a.m. EST. Okay, so you can deduce the potential higher of the day, or you can also deduce the directional bias for London itself using the London 4-hourly candle as to how that London 4-hourly candle is going to print. So for that, you're going to be using your profile. So you have your daily profiles, right, by ICT. You can use those. But instead of the daily open, you're going to be using it on the 4-hourly open. Okay, which should give you the high or the low. Yep, so anticipating the London price delivery. So we use the 1 a.m. EST opening price and transpose daily open profiles onto the London session. Exactly what I just mentioned, okay, or what I just said. All right, so the purpose of London's price delivery, and I'm just going to read this out loud. The main purpose of the London session is to deliver, it's delivery price, bro, man. Now that's a typo. I don't care, okay? Is to deliver price into extremely important liquidity pools so that large institutions, hedge funds, mutual funds, and even central banks have the opportunity to deload positions into these liquidity pools and or accumulate more positions through the liquidity available from these important liquidity pools. Okay, so what does that mean? It means that London, okay, to break it down, London is going to deliver price into these important liquidity pools. Okay, may it be for a retracement, may it be for a complete reversal, it will deliver price into these important liquidity pools. And if you recall from the earlier videos, I said a liquidity pool that is important does not necessarily have to be a high or a low. Okay, it can also be an inefficiency in price where limit orders are placed. Okay, so the strength of these liquidity pools will be known based on the reactions of price once it reaches these levels. So meaning sharp reactions indicate large neutralizations. Okay, and range bound reactions indicate small scale position neutralization that leads to an accumulation of new orders for either a reversal or a continuation. So what does that actually mean? So whenever price comes to these important liquidity pools and we get a sharp reaction, okay, it means that the level of volume of orders coming down or up into that level have been almost completely neutralized. So when I say neutralized, I'm saying, let's say you're going for a bullish scenario and price is coming down. So let's say price is coming down with the 100 orders. Okay, let's say price is coming down with 100 orders of sells, let's say, and it comes into a fair value gap. Okay, and that fair value gap literally finds counterparty for these cells via limit orders. Okay, it finds counterparties via limit orders. So someone is willing to buy from that price, or large institutions. Okay, so now when this, let's say the central bank, let's say the Fed buys all 100 of these sell orders, right? They literally assume that position, and they assume more positions at that, which completely neutralizes that net short and makes price for that particular asset class net long. Okay, so there's going to be a net long position on that asset class for the new price swing that's about to be delivered to what? Buy side liquidity. Okay, I hope you understood that. If not, you can hit me a DM on Telegram, Instagram, whichever, right? And I'll be happy to answer that question for you. Okay, so the fun of it is that we won't know until price reaches these liquidity pools, right? Because we don't know who or what entity is keeping the orders in that fair value gap, right? So the best part is, or the fun of it is, we wait for price to come to a POI, wait for the reaction, get our confirmation, SMT, range valuation, order block, whatever it is that you like to use, and go for it. If your model says enter, you enter. Okay. Next up, ending London's price delivery. So London delivery ends at 6 a.m. EST. All right. So now what's the algorithmic part of this? Now I've explained everything, but what's the step-by-step approach of going about this? Number one, look at where price opens at 1 a.m. EST. And you're going to observe price until 2 a.m. EST. And you're going to be asking yourself, did price raid an important liquidity pool, or did price reach a bullish bearish point of interest for reversal or for continuation purposes? So these are questions you should ask yourself. Your model should determine what's going to happen next, right? Does your model say, okay, this is going to be a buy from a bullish POI? Okay, go for it. So in the case of number 3, London has already done its job. Now look at the distinction between number 3 and number 4. Number 3 says, did price raid an important liquidity pool? So now this means highs and lows. But number 4 says, did price reach a bullish or bearish POI? So that's what? Fair value gap, bullish order block, all that. So that's limit orders. Number 3 is stops, number 3 is limits. Okay. So in the case of number 3, London has already done its job. What's the job of London? To deliver price to extremely important liquidity pool. So in this case, it's like a stop hunt, or it's like a break-in market structure, a major break-in market structure. Okay. So then you should be asking yourself, where is price likely to be drawn to next? So that's higher time frame perspective. If you look at structure, look at liquidity, look at fair value gaps, where is price inefficiently traded? We want to see price being efficiently traded there, all that good stuff. Okay. Now in the case of number 4, here to ask yourself, was there confirmation of a reversal or continuation? Okay. So if price comes to a bullish point of interest, like in the earlier example, is there something over there that your model says that you can buy? If so, go ahead and do it with proper sound risk management, right? Therefore, to end this, you have to understand the intentions of London delivery by looking at the overall picture, by seeing how Asia behaved, and you're going to use that information to understand how London is going to behave. After that, you want to be looking at the higher time frame, 4 hour, 1 hour daily, to see exactly what market structure is unfolding, where the draw is, and all of that smart money, good stuff. All right. So with that, let me take you guys to the charts. I'll give you like maybe 2 or 3 examples, right? Okay. So I guess we can just use this over here. Or do you want me to go? Let me just go back a bit. Okay. 1, see now I don't know what's happening. Go back. Okay, here. Let this load first. All right. So let's go replay mode up until here. All right. Now look at, okay, this is a weekend. So let's go back here. All right. Let's use these 3 days. Okay. 1, 2, 3. All right. Get Asia. Okay. So we have Asia. All right, so we know Asia is consolidating. That's the most ideal Asian range, right? Now, if we find the 1 a.m. opening price, which is, I think it's here. Yes, it is, right? That's for London. Ends at 6, right? So at 6, we ended over here. Okay, we ended at 6 over here. What can you see happening? Price is going up what's the potential profile that you are seeing? Obviously, you're going to have to use context. You have a break in market structure here, return back to the origin, and prices starting to sell off. So we understand that this is just going to be a stop fund to drop lower. Okay, so that's your context. That's your higher time frame context. That's your or for that. That's the entire process of following order flow. That's up to you, not up to me at this point. All right, so that's up to you. So over here, what can you see? What's that profile from ICT's book of profiles? What does it look like to you? It looks like open, up, down. Now you see this candle over here, it goes down and wicks up, right? So what does that mean in terms of looking at the opening price? Retracement, lower, right? So that's your London sell. Looks to be a London sell, right? So everything's there for a London sell. All right. What's the purpose of London? The purpose of London is to get into liquidity and or inefficiently traded price action. Okay, or inefficiently traded price action. So if you're looking to sell, we're looking for what? Liquidity and inefficiency, right? So over here, what can we see? We can see that there's a stop hunt down up. We know that this low is protected. So what else is there? One continuous leg of bullish price action. So if we go to the higher time frame, this is definitely a fair value gap. Okay, this is definitely a fair value gap. Let's check the 1 hour. There you go, from here to here. It's a fair value gap here. There's an imbalance here. Again, I denote fair value gaps and imbalances differently. And this is bullish order block, with this being your unmitigated portion of that bullish order block. Okay. I'm not going to go into the specifics of that, but that's what it is. So London has done its job. Okay, so let's go to the next day. Large range Asia. All right, so what are we expecting? We're expecting London to be kind of quiet. So what's the type of profile of algorithmic delivery that we're going to be looking for? We're looking for this. So we have the opening price here. 6 o'clock is right there. All right. Okay, price goes down once. Okay, fine. Goes on up one more time. Okay, that's also good. So we are thinking that, okay, it's going to be a sell, but we want to see a displacement for that sell, right? No displacement. What's happening? We can see that this low is protected. Small imbalance over here, fair value gap over here. Price comes and fills it up over here. Fills it up over here. It goes up again. It comes back down. So there is no proper indication of there being bullishness or bearishness. So what's happening over here? Opening price, down, up, down, up, down, up, down. What's this? Looks to be like a seek and destroy type of scenario, right? Taking stops here, taking stops here, taking stops there. No, not there. Over here, taking stops here, taking stops here, taking stops here. It looks to be a seek and destroy profile. Simple. And how are you going to come to that conclusion? Look at Asia. Open, up, down. What does it look like on a line graph? Open, up, down. Then we consolidate. Is that something to expect? Yeah. If Asia is ranging like that, or if Asia is a large range, then you're going to expect one of two things for London, right? Like I just mentioned in the slideshow. Either it's going to be a consolidation or it's going to give you that nice sharp reaction. Okay, going to give you the nice sharp reaction. And if I draw it over here also, it looks to be like this. Crude depiction, but yeah, looks to be like this. Okay, so here's a nice sell day, or selling London, or sell London, London sell, London sell. Here's a London consolidation. Okay, this is not ideal at all. Okay, not ideal at all. Final example, nice large Asian range. All right, that's a given. Fine. Let's look at 1 a.m. right here. It's open. Yeah, open. 6 right there. All right. Asia, what happens? Asia trends. Maybe consolidate here. Okay, consolidate over here. Maybe nicely drop. Now wait. I mean, as you drop here, you're not going to do anything. Why? Because this consolidation is what you want to see. Now, what we want to see is that willingness to move away from the consolidation that's seen over here, right? So are you going to get anything done? That's the question. Are you going to get anything done in London? Unfortunately, if you're going to wait for confirmation, you will be waiting until New York. Okay. But if you want to get anything done in London, you have to use high time frame context as to, you know, what overall structure is and all that good stuff. All right, all that good stuff. Maybe this could be inducement to go higher. Could be one of that. It could be something like that. Okay. So let's look at this over here. So we have the opening price for Asia and for the day also. Price goes up, starts to consolidate. Opening price for London, price goes down, consolidates, and then displaces. What does it look like? It looks like a sell day, but minus the jab above the opening price. Okay, minus the jab above the opening price. Okay, how are you going to get in these type of moves? Wait for the next session, or you simply keep your limit orders at the fair value gap there, stops here, and you are expecting London to do something, right? Expecting it to take stops, expecting it to fill in efficient price action. So we can see that here we have relative equal lows, this one to that one. Can you target that? Yeah. What about this low? Is this a low that is in an important session? No. Can you target it? Yeah. Yeah, they played forward. There you go. And then the next week starts. Yeah, the next week starts. So I hope this really helped you guys. What you have to understand is the intentions of price delivery for London. Okay, so that is to create liquidity or go into bullish bearish POIs following Asia's price action. Right, guys. So remember, well, it's my doors are always open. You can text me anytime. You can send me a message on Telegram. You can send me a message on Instagram. And if you like what you saw, don't hesitate to like, comment, and subscribe. If you don't like it, get lost. And remember, if the market is algorithmic, so your trading can definitely be objective. All right, guys. Peace. See you in the next one. Bye-bye.